Hello, this is Mike Gallagher, Director of Research IDEA Global. I'm here with Eric Homberg today. We're going to look at two issues. First of all, we're going to have a look at four of the majors in the FX market, and then we're going to have a little bit of a look at some of the long-term picture in terms of the Eurozone. With the market still very heavily sort of debating what's going to happen with the US debt ceiling, it's probably quite a good time to actually have a look at the currency market, which has been quite choppy in the recent past. If you look, I think, at the way that the market is approaching this, the critical question is the length of the debt ceiling increase. If we are able to get a debt ceiling increase that brings us through the end of the year, there's an assumption in the market that the risk-on trades will return with a vengeance, given that the Federal Reserve is unlikely to undertake tapering at the December meeting, and consequently we could see a spillover into the FX market and riskier currencies generally doing quite well. But let's have a look at the technical picture on a couple of the majors, because I think we're at quite an interesting sort of juncture, at least in the bigger picture. Obviously it's a bit more difficult short term. Eric, we've got this chart first of all in terms of euro-dollar, and you're saying that we're approaching tough resistance at 137.10 in the bigger picture.
Yeah, I think 137.10 is a major level on the upside, the February high. I can't see it breaking through there unless there's a sort of quite different environment to allow people to trade through to 140, even 142.5. So expect very tough trading. As you can see, the last month it's really struggled on the approach to 137.10. Key level now on the downside of 134.50. I think if we fail below there, we could see the start of some deeper unwinding back down towards even 132.5, and that takes us back into the sideways range we've been in so far this year.
Let's also have a little bit of a look at dollar yen before I sort of add a few things into the mix. You're saying that dollar yen is nearing sort of resolution. We've had this large sideways pattern essentially since April of this year after the dramatic plunge of the yen.
Yeah, if you look at a longer term picture, we've had last year had a very sharp move higher up through to April. And we've had this sort of convergent triangle pattern sort of forming. We're nearing towards the end of that sort of resolution, either to break up or break down. Really looking for trading back above parity or 100.60 to sort of give us a feel for testing higher towards 103.75. The view is still bullish as to break higher. Key supports at 97, 95, 80. I think if we fall below there, we could see this whole pattern start to unwind back down to the downside. So really looking for a break above parity, 160, to see some signs of a break higher.
I think one thing that's kind of interesting looking at these charts and listening to you is that the period of decreasing volatility in foreign exchange is unlikely to last sort of going forward. We're coming to sort of important periods in both euro-dollar and dollar yen, and consequently, I think given the way that vols have been hit, particularly at the front end of the currency options curve, there's potential opportunities to play for high volatility into year end. I think that's certainly sort of one theme. I think it's also interesting that dollar yen generally has sort of mirrored a bigger move in terms of the dollar, and it could well be that a resolution on dollar yen actually gives us some direction in terms of the European majors. So I think that's one thing to also add into the mix. I think the third thing is when we actually come to the euro, you've got a situation where European equities have actually sort of performed extremely well over the last number of weeks as the whole Fed tapering debate has been delayed. And indeed, European equities have actually outperformed the S&P 500 since the 22nd of May with Bernanke's testimony to the GEC. And I think there's sort of a sense that Europe is kind of the asset allocation of choice, whether it's equities or fixed income, going into to year end, because it's underowned, it's underloved, and we're not falling off the cliff now in Europe, and we might even have a cyclical recovery. I think all of those do have a certain degree of merit, but I think, as we'll sort of see later on in terms of some of the longer term comments we have on Europe, we're a little bit apprehensive about playing Europe too far. And I think ultimately we think that some of the relative optimism that currently exists on Europe may well just be sort of a tactical trade. The market's somewhat long from a positioning standpoint. You can see that in the IMM commitment of traders data. So consequently, I think if we go back to Eurodollar, we could well sort of resolve with a dollar breakout. But I think for the moment, we have to wait and see for the actual breakout to come. And I think we have to probably watch dollar yen. Cable and dollar Swiss are sort of interesting as well in terms of overall dollar direction. We've got cable up here, Eric. Struggling on approach to 163 to figure 163.80 is what you're saying.
Yeah, I mean, it's a similar sort of, in a way, to euro dollar. We've got this major level at 163.80 and 163, which happens to be the 30-year average for cable. So there's some quite tough resistance to break higher. 170 is the sort of top end of the sort of cable trading normally. We do see the breaks to parity and up above 2, but they don't last very long, and most of the trading in the last 20, 30 years has been between 140 and 170. So we're in the sort of upper band of normal trading in cable. So it's very, very hard to see that breaking a lot higher without a major change in the market. So we're seeing this sort of struggle, potentially the head and shoulders there pattern just starting to sort of unwind a bit. So the trend line there, we're touching 159. So breaking below there, we could see certainly a decent correction down back into the sort of range we've had so far this year. Levels at 157.50, 156.05, and even down towards 155. So the potential for a correction is quite strong, even though cable still remains quite bullish in its present form, but there are worrying signs as to whether there's enough conviction to break 163.80 and trade up towards 170.
Sure. Now, I think it's kind of it's interesting that the dollar trend can dominate there potentially overall. We wouldn't necessarily see major negative news on the UK front per se, and if anything, we'd still probably favour Euro sterling down to around 82.30, i.e. sort of cable lagging a little bit behind euro dollar. But let's come on to dollar Swiss. That's a real sort of interesting one, because we've kind of had a look at the downside, and there's kind of real critical levels at 89.30, and on the majors, it's probably one of the nearer, or was one of the nearer levels that we looked like sort of testing. We haven't quite got there yet. Are we failing on the downside?
I mean, we've been stuck in this range between sort of 89.30 and parity for the last 2 years, and we've been bouncing around. We're having a go at it, but it doesn't look like we've got a lot of conviction there. We've, this sort of corrective move higher from 89.70 we traded early in the month. It looks a bit, it looks quite strong in terms of a support base there. 91.30. 91.50 is the sort of the resistance levels. If we can break above there, it sort of all becomes a bit more congested, and we move back into that sort of safe zone between 90 and parity.
I think to the degree that we're actually, towards the bottom of that wider range, that 90 to sort of parity, I think this is really sort of interesting. At the moment, the Swiss franc is being sort of helped by the concerns surrounding the US debt ceiling. The market's going through a rethink on that, and certainly the signs are that we're approaching a deal in the next 3 to 4 trading sessions that should lead to an extension of the debt ceiling. I think once we get realization of that, the Swiss franc is probably just a bit over-owned from a market sort of perspective. Whether you look here at dollar Swiss or you look at euro Swiss, is just too rich relative to the broader risk environment. The other thing that's probably worth pointing out in terms of the Swiss franc, it's the last of the big safe havens that have yet to capitulate. If you look at the yen, gold, U.S. Treasuries, you know, the period since last autumn have seen a real capitulation in all three of those former safe havens that were you know, extremely sought after in the 2010 to 2012 period. And now with the world less at risk of a major European breakup, the question is, you know, why should the Swiss franc remain so overvalued? And I think tactically, you know, we actually think that this is probably one of the best trades. And I think, you know, if Eric, you know, pointing there to 91.30, if we get the break on that, I think we'd certainly sort of play that quite aggressively, looking for 95 multi-month, and you know, could be one of the best ways to play the dollar. So that's a roundup just in terms of some of our latest ideas in terms of the majors. I also want to now spend a little bit of time looking at Europe. As I mentioned, there's a lot of optimism regarding the Eurozone at the present moment in time. There's a sense that the cyclical recovery is gaining ground, and certainly some of the soft survey numbers help to build up that theme. There's a sense that we've moved away from the acute phase of the Eurozone crisis towards problems, but they're country-specific rather than systemic. And additionally, there's sufficient crisis mechanisms in place and architecture building, such as the single supervisory mechanism or the single resolution mechanism, which can provide some confidence to investors. I think if you look during the autumn, you know, we'd be relatively relaxed in terms of the European picture. The effective defeat of Berlusconi in the latest political maneuvering in Italy now means that the current government may well sort of endure right through the spring of 2014, and certainly you've got confidence for 9, 12 months that you'll have the current Italian government in place. If you look at Greece, Portugal or Ireland, then in terms of Greece, the funding gap of 10 billion euros in the second EU IMF program, we're unlikely to see it all being breached and funded this time round, but I think there's going to be enough of a willingness to kick the can down the road again to actually fund the portion through to end 2014, and that can keep Greece off the radar. Portugal is an issue. It does need a second program. The Europeans have made clear once again that they're willing to offer any sort of support should Portugal require that. And we think it can return to be an issue. But it looks as though the negotiations are going to occur in the first quarter of 2014. And then in terms of Ireland, it's all a question of relative positives. There's two views. Either Ireland can tap the ESM ECCL facility, which is a precautionary credit line, or alternatively can go cold turkey and go without a safety net once the current 3-year program ends in December. This is not an issue in itself that inspires markets, but it is important in terms of the OMT context. If Ireland were to trigger the OMT, then it would actually add credibility not only to Irish assets but to European assets in general. And this is going to be one of the themes that we'd sort of watch through the course of the autumn. I think it's not clear to us that Ireland would automatically sort of tap the ESM for an ECCL facility. The bias is probably in that direction. But then there's going to be a debate about whether Ireland needs to request from the ECB the OMT being activated. If you look at the funding position for Ireland, they're already funded right through 2014, and their funding for 2015 is a very light 5 billion euros. It seems to us that in the current condition, and given the progress that Ireland's made, as for example shown in this IMF debt sustainability analysis, where they're looking for the government debt to GDP ratio to decrease through 2018, that Ireland should be able to very smoothly fund the situation that they currently and prospectively face in most core and even adverse sort of scenarios, and is unlikely to need to actually activate an ESM ECCL facility. That means that they may not request the OMT anytime soon. Additionally, the ECB might be reluctant to undertake anything actively too soon, given the outstanding decision that we're still awaiting for in terms of the German Constitutional Court and its ruling on the OMT. But overall, I think in terms of the autumn, we should still see a relatively constructive backdrop. The ECB is likely to maintain its easing bias. We think that they could sort of deliver a 6 to 12 month repo to fine-tune liquidity in the system. They will still dangle the carrot of refi cuts into 2014. And the recovery is one thing, but the ECB is also very focused on negative lending growth and the risk of disinflation and inflation undershooting the price stability target. So these themes can sort of provide a bit of a constructive backdrop for Eurozone assets generally into the year end once the picture in the US is clarified somewhat. If you look long term, I think there's a distinction needs to be drawn between sort of the cyclical sort of the position where we're seeing a bit of a bounce and some of the long-term headwinds which can not only restrict the degree of recovery in the Eurozone, but additionally can produce some significant problems on a longer-term basis. The good news is that fiscal tightening in 2014 is going to be sort of significantly lower in the Eurozone than has been the case in 2012 or 2013, as shown, for example, by these projections from the IMF. Nevertheless, fiscal consolidation will remain a headwind for the Eurozone recovery. Of greater concern is the whole deleveraging sort of question, and this is not just the government undertaking fiscal consolidation, but the private sector, banks, households, and corporates. And in a number of European countries, you've actually got all of these sectors which are in excess of commonly regarded international standards. And if you listen to the IMF, the OECD, the BIS, they're consistently sort of dour on the case of the Eurozone on a multi-year basis because the deleveraging process is so slowly advanced, either compared to some other countries in the OECD, and particularly compared to historical experience in terms of deleveraging phases. And this is going to be a major headwind for Eurozone growth, both on a cyclical and a structural basis going forward. We've also got problems in terms of the amount of foreign assets that are still held in a number of countries. This showed the net foreign asset position. If you look at the bottom there, the worst is Portugal with over 100% of GDP. And if you look at international standards, anything over 50% is regarded as excessive. You've got an improving situation for Greece, partly due to the lagged effects of the debt restructuring. You've got the dotted line there, which is Spain, which is just moving away from 100% of GDP. And then you've got the green dotted line, which is Ireland, where the current account surpluses are cumulatively helping to pay down the amount of debt. I think when it comes to Spain, Portugal and Greece, there is still sort of a genuine case that foreigners own too much of domestic assets, and at some stage in the future, if we don't see a sustainable recovery, they can undertake another wave of liquidation. And this is particularly sort of important for Spain, where the amount of official funding is much smaller than either Portugal or Greece, which have undertaken larger programs as a percentage of GDP. This is an Achilles heel, and it's not just an academic issue. It's an issue that the ECB President Draghi has put as the root cause of the Eurozone crisis. So it is worth reflecting on that. The other point to make is that we've got another funding hump for the Eurozone banking sector. If you remember 2012, we were all worried in late 2011 about the amount of bank bonds that were maturing in 2012. Well, the news is that the hump is even bigger in 2014 and 15 in terms of bank bonds maturing, both in terms of core Eurozone banks, which admittedly should be relatively okay in terms of rolling over that amount of debt. You've still got $750 billion of peripheral country bank bonds maturing in that period. And that's going to be a bit more of a trickier exercise, especially through the EBA stress tests and the ECB bank asset quality review that we've got next year. So overall, I think our sense is that the current sentiment towards Europe can continue to improve into year end, but 2014 is still going to be a very testing time structurally and ultimately cyclically for the Eurozone. And we'd still see sort of sufficient problems re-emerging, particularly for Portugal, but also to a degree Spain over that time period. If you've got any questions or any comments, we're more than happy to hear from you. Please feel free to contact myself, Mike Gallagher, or Eric Holmberg, or alternatively the research group at research@ideaglobal.com. Thank you very much.